Investing in the stock market can be exciting and rewarding. However, it can also be a daunting task filled with risks and uncertainties. In order to make informed investment decisions, it's crucial to be aware of the common mistakes that can derail your investment success. In this video, we'll explore the top 5 mistakes that stock investors often make and provide practical tips on how to avoid them. Whether you're a new investor or looking to improve your investment strategy, this video will help you navigate the stock market with greater confidence and make better investment decisions. So, let's dive in and learn how to invest smarter. Mistake 1. Following the crowd. This is a common mistake that beginner investors often make when starting out in the stock market. This refers to the tendency to invest in popular stocks or follow the investment decisions of others without doing proper research or understanding the underlying reasons behind these decisions. One of the biggest risks of following the crowd is that it can lead to herd mentality, where investors make decisions based on the actions of others rather than their own analysis and research. This can be dangerous, as the investment decisions of others may not align with your own investment goals, risk tolerance, or financial circumstances. When a stock becomes widely popular and gains significant attention from the media and investors, its price can become inflated due to high demand. This can result in a situation where the stock is overvalued and may not have much upside potential left, making it a less attractive investment opportunity. Popular stocks can also be subject to higher volatility and market fluctuations, as they may be more sensitive to news or events that affect investor sentiment. To mitigate this risk, it's important to remain vigilant and aware of market trends, while also conducting your own research and analysis to determine the investment potential of a stock. This can involve assessing the company's financial performance, market trends, competitive advantage, and other relevant factors that can impact the stock's growth potential. Mistake 2. Investing a large portion of your savings or capital in a single stock without diversifying your portfolio or understanding the potential risks involved. One of the biggest risks of investing too much capital at once is the potential for significant losses if the stock does not perform as expected. If the stock experiences a decline in value, your entire investment may be at risk, leaving you with significant losses and little to no diversification to mitigate the damage. Another risk of investing too much capital at once is the potential opportunity cost, where you could have earned more returns if you had diversified your investments. Diversification and dollar cost averaging are two important strategies that can help investors avoid the mistake of putting too much capital at once in the beginning. Buying an index fund that tracks the market is an effective way to diversify your portfolio and spread your risk across many different stocks or companies. Dollar cost averaging, on the other hand, is a strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This can help to smooth out the returns of your investments over time and reduce the impact of short-term market fluctuations on your overall returns. Mistake 3. Lack of proper risk management. Investing in the stock market is generally considered riskier than holding cash, bonds, or real estate, and it's important for investors to understand their risk tolerance and to develop a solid risk management plan before investing their hard-earned money. Many beginner investors fail to conduct thorough research on the companies they choose to invest in and understand their business models, financials, and growth prospects. They also don't monitor news and events regularly after purchasing a stock, which can prevent them from staying informed about potential risks that could impact the company's operations, financials, and ultimately, its stock price. Some investors even choose to invest using margin loans, which allow them to borrow money from their broker to purchase stocks, with the securities they own serving as collateral. One problem with this is if the value of the stock you bought goes down and you can't pay back the money you borrowed, the broker will ask you to put in more money to cover the loss. This is called a margin call. If you can't put in more money, the broker may sell your stock to cover the loss, which results in you having to crystallize the loss. While margin trading can potentially amplify gains, it can also magnify losses, which can be disastrous for beginner investors who may not fully understand the risks. Mistake 4. Making emotional decisions. This can happen when investors become too attached to a particular stock, because they feel emotionally invested in the company's success or because they have a personal connection to the product or service the company provides. As a result, they might hold on to the stock for too long, even if the company's financials are deteriorating or the stock price is falling. Similarly, fear might cause investors to panic sell their investments during a market downturn, even if they are long-term investments that would likely recover over time. On the other hand, greed might cause investors to chase after hot stocks or investment opportunities without conducting proper research, leading to investments in high-risk and potentially fraudulent schemes. It's important for beginner investors to develop a solid investment strategy based on their financial goals, risk tolerance, and time horizon. They should also stick to their strategy and avoid making impulsive decisions based on emotions or short-term market movements. Mistake 5. Becoming overly confident in their investment abilities. Many new investors experience early success in the market and begin to believe that they can consistently beat the market or make profitable trades without proper research or analysis. Overconfidence can lead to a number of dangerous investment behaviors, such as taking on excessive risk, ignoring warning signs or red flags, and failing to diversify their portfolios. For example, an overly confident investor might put all of their money into a single stock or investment, convinced that they have a special insight that others do not. This behavior can be particularly dangerous when it comes to high-risk investments, such as penny stocks or cryptocurrency, where the potential for large gains can be alluring but the risk of significant losses is also high. Overconfident investors might ignore warning signs, such as poor financial performance or regulatory scrutiny, and continue to invest in these high-risk assets, leading to significant losses. It's important for investors to remain humble and disciplined in their investment approach and be wary of any investment opportunities that promise quick or guaranteed returns, as these are often high-risk schemes that are unlikely to deliver on their promises. The average investor should also have realistic expectations about the annual return on their investment. Achieving a 10% annual return consistently is generally considered a very good long-term return for most investors. In fact, the historical average annual return of the S&P 500 has been around 10% over the past century, and studies have shown that most individual investors tend to underperform the market over the long term. Warren Buffett, who is considered one of the most successful investors of all time, has achieved an average annual return of about 20% for more than 50 years. This shows that while achieving a high annual return on your investments can certainly help you accumulate wealth more quickly, it's not always necessary to achieve extraordinary returns to become rich. Let the power of long-term investing and the benefits of compounding returns work its magic. Investing in the stock market is an art that requires patience and discipline. Long-term success in the stock market requires you to keep your emotions in check despite market fluctuations. Remember to do your own research, diversify your portfolio, practice risk management, stay informed, and remain humble. By following these guidelines, you can increase your chances of achieving greater success in the stock market and building long-term wealth. If you like this video, please give it a thumbs up and don't forget to subscribe for more investment tips and insights. Thank you for watching, and happy investing!